Hello everyone, welcome to this episode of Stock Market Investing for Beginners. So today we are going to discuss about a strategy which we can take as a new investor to maximize return and then reduce exposure to risk. So as you know, in the stock market, there is nothing called safe. Every investment comes with some sort of associated risk, but we'll see how we can minimize risk by investing in ETF. So before starting, just as a disclaimer, I'm not a financial professional, so all my opinions here are my personal opinions. So if you have any, um, if you want to invest, please do your own diligence and, or if needed, talk with a financial advisor. So what are ETFs? So ETFs are a collection of either stocks or bonds. So you can think of a big bucket of, say, like 50 stocks behaving like a single stock as a ETF, or maybe 50 bond behaving bought and sold in the market as a ETF. So in a single ETF, might have a 50, 100, or 500 companies stock. So today in this video, we are only going to talk about stock-based ETF, bond-based ETF we can discuss in another episode. So ETF usually tracks a index or a industrial sector. So what are the index? So index basically can be a collection of certain segment of the market. For example, S&P 500 index have the largest 500 company in the US. So some of them are financial companies, some of them energy, some of them information technology, right? So these are a combination. On the other hand, industry-based one tracks only single industry. For example, financial ETF will only have some of the bank and other financial stock in their portfolio. And usually ETFs are issued by some of the large companies like Vanguard, Fidelity, or Charles Schwab, right? So what they do, basically, they do some market research, comes up with the industry or index, and then create a ETF with all those companies inside and then sell them to the investor as a single equity. So like stock, individual stock, there are always some sort of performance indicators are there. And as an investor, we should be very careful about those performance indicators to see the investment we are doing is solid enough. So like stock in ETF, we need to do some due diligence, and some of the key parameters can be always double checked. One is the sector performance. So many sectors, say like for example, energy or financial, are cyclical. So currently, as you know, the oil price is low, so the energy sector is lagging, it's not performing very well. The price of that ETFs or stocks are down. Probably dividends are not also that great, right? Same thing can happen with the financial industry. Currently, they are doing good, but many of you remember the 2008 financial sector crash that bring down the value of all those banks and other financial sectors. So some sectors are cyclical. On the other hand, some sector can be very stable. For an example, consumer staple. So companies like Coca-Cola, Procter and Gamble, or Johnson and Johnson, they produce product that people always use. Doesn't matter what is the market conditions. So those are more like a stable sectors that perform on average at every market scenario. So you need to make yourself comfortable at what sector you want to invest, or are you okay with the cyclical nature of the sector? For example, if you are investing for 10, 15-year time horizon, then probably you don't care too much about the cyclical nature of the sector. But if your time horizon of investing, say like you want to invest today, in 1 year or 5 months, you want to some return, then probably you need to be, giving more emphasis on that. Another thing like stock, you also want to see the transaction volume of that ETF. So for example, if you buy a stock of Coca-Cola, you can buy anytime and sell anytime because the volume of that Coca-Cola stock is so big, there are always people willing to sell and willing to buy. So same thing with the ETF. You need to make sure that the ETF has enough size or asset inside it so that anytime, if needed, you can buy and sell. Another thing in ETF you need to pay that you don't pay usually in a individual stock is called the expense, because companies who come up with the ETF or issue ETF, they need to employ some expert people to pick up the stock and maintain it and time to time update that, right? So there is some management cost, and that comes as expense ratio. So usually EPS, the ETF expense ratio can go from anywhere 1% of the stock price to maybe 0.5%, 0.05%, and so on. So maybe it doesn't look a lot in a short period of time, but say in 10, 15-year time period, that expense, high expense, can eat up big portion of your gain. So we need to be careful that when you invest in ETFs, look at the expense ratio and see how big is that. Also, one thing need to look to evaluate the performance is a long time performance. So usually I like to see at least a ETF that was created 3, 4, or 5 years ago at least. Because if a ETF was created last year and then it's doing really good, I'm not sure in the long term how it will do. But if a ETF was created, say back in 2005, it's already almost 20 years, and I can see on average how it did in the market. So the longer the time horizon of ETF is better, because then you can see its average return. And the last thing is most important thing, what are the holding companies in that ETF? So as I mentioned, ETFs have multiple companies inside. So you need to see all the stocks inside the ETF you can trust or not. And later I will show you how to check that. So let's look at the two of the, I would say, very common ETF in the market. First one is index tracking ETF, Vanguard S&P 500 ETF, ticker symbol VOO, which tracks or which has all the 500 companies inside the S&P. And another industry tracking one is Fidelity Information Technology ETF. So to check them, you can just go to Google and then type VOO or Vanguard S&P 500, and you come over here. So usually I like to search them from the company that issue that equity. For an example, here Vanguard. For Fidelity, I go to Fidelity. You can look from the Yahoo Finance or other sources, but usually the issuing company will always have the most updated information. So if I look at the Vanguard S&P 500 ETF, so currently I can see its expense ratio is 0.03% only. So this is really good. For an example, if I invest $10,000, every year I'm going to pay only $3 as a management fee. So which is really good. But some of the companies you might see that 1% or 1.5% expense ratio. So this is something you need to be careful, because it doesn't matter you lose value in ETF or gain value, you are still going to pay. So for an example, if next year a financial crash came and your stock become half, but you are still going to pay the same 1.5% expense ratio, which is going to eat up a lot of the value of your ETF. So try to see a ETF which is a very low expense ratio. And currently I can see its market price is $269 and yield is 1.97. So yield means your dividend. So that is another thing sometimes it's good to look at if a company if a ETF has a good yield. So the good thing is that on top of the growth of the ETF, you are still going to get 1.97% back as a dividend. So even when the market is down, your ETF price is down, you still get some return back in the form of dividend or yield. Next thing, as I mentioned earlier, always look at the long-term performance. So you can see that this ETF was created in 2010, and since then it is doing about 14% return on average, so which is really good. And here you can see a kind of a idea. If you invest $10,000 in 2010 period, now at 2019 probably it will reach 30,000, more than 30,000 valuation. So I can see it's more than 5 years in the market, is doing okay or doing good, so I can get some confidence in the performance of that. And here you can see that what are the type of sectors or industry sector they are investing. So as you can see in communication services like AT&T or Verizon, those kind of communication company, they have 10%, consumer staple 7%, energy 4%, finance 12%, right? So that means it's well diversified. So if one sector, for an example, energy is doing bad, probably financial or information technology sector is doing good. So in general, you will be in a good shape. Here you can see the top 10 largest holdings. So you can see in this ETF, you have Microsoft, Apple, Amazon, Alphabet, or Google, and Facebook, and so on. So I can see these are the big companies with a very stable performance. So probably this ETF is going to do good in the future because these are the quite solid companies. But then again, nobody knows future what happens in the stock market. But at least we can get some idea. This is not made of some unknown small companies, right? And to look at the expense ratio, price and performance again, you can go to the next tab and look at again their performance and so on. What are the, let me see where they have the asset currently. Somewhere there will be a total asset, and here are the some market return and so on. And you can go to portfolio and management, and here are some of the more detailed information. So number of stocks. So currently there are about 580 stocks. And under this ETF, you have $114 billion invested, right? So median market cap is pretty high. Price to earning ratio, that is, I also look at. Usually it should be around 15 as average, but it's little high because nowadays everything is slightly overvalued. So, and you can also see the earning growth rate. So every year it's earning increasing by 10%, which is good. So this is a common way to evaluate a ETF. So the next one is Fidelity MSCI Information Technology. So you can go to Fidelity site, give a search, and same like the other one, they also have all the information listed over here, hypothetical growth, some price to earning ratio, overall growth. So you can see this one actually is growing about, it was released in 2013. So about last 6 years, it's growing about giving return 18%, so which is really good. And here are the some of the largest company inside that ETF. So it has more stocks you can see from here, but you can see they are top 10 holder over here from Apple, Microsoft, Visa, MasterCard, Intel, and so on. So let's go back to our discussion again. So some of the good thing and bad thing about ETFs. So good thing is that you are minimizing your risk rather than choosing a one single company. You are distributing your money in multiple companies. So some of them will do bad, some of them will probably very good, and on average, probably in a long term horizon, you will be doing okay. And the good thing is that you can buy anytime or sell anytime ETF. So I can buy ETF now after 2 hours or maybe one day, I can sell it just like a stock. And usually they come with a lower fees compared to mutual fund. So we'll talk about mutual fund in another day. But the fees are not very high, but you need to still do your own research. And the con is that nowadays there are so many ETFs in the market. I assume there are more than 2 or 3,000. So you need to make sure what are the details of that ETF, or which company they invest in. Are those some, unknown companies or with a shady business, right? We don't know. So you need to make sure that what are the top holdings and what are the total list of the holdings, how many companies are there. And then I discuss expense ratio, long time performance, right? A couple of things. So we need to be careful about that. So how you invest in ETF, you can always buy, just create your, say, investment account with Fidelity or Vanguard, put some money from your bank and buy them. Or uh, nowadays, a lot of us, we use Robinhood or M1 Finance and so on. You can just go create an account, search the ETF, and if you have money in your balance, you can always buy them, right? So these are super easy to buy and sell. and there is no minimum required. So if, say for an example, if a ETF is selling at $80, you can buy just one ETF at $80, and that's it. So before finishing the video, I'm going to give a comment from Mr. Buffett, who is the biggest investor or most successful investor in history, and he also actually had some suggestion in or preferring investing in ETFs. So he said, my advice to the trustee could not be more simple. Put 10% of the cash in short-term government bond and 90% in a low-cost S&P 500 index. So someone asked him a question: when you are no more uh, in charge of running the business, what is the suggestion for the people who will hold your trust? So that is the thing he's saying: invest in a low-cost index fund like a Vanguard S&P 500 or Fidelity S&P 500, right? Because they're well diversified, and they, in the long term, they give considerably good return. So that's the end of today's video. So if you have any comments or suggestion, please put in the comment box below. So until next time, thank you.